AstraZeneca's bold move has just exposed a gaping hole in the UK's tax system, and is one that could cost the Treasury dearly. Here's the bombshell: by listing its shares directly on the New York Stock Exchange while keeping its presence in London and Stockholm, AstraZeneca has effectively killed stamp duty on its shares in the UK. But here's where it gets controversial: this isn't just a win for the company and its shareholders. It's a wake-up call for Chancellor Rachel Reeves and the entire UK tax regime. Let's break it down. AstraZeneca's proposal, which sailed through with a staggering 99% approval rate, benefits everyone on its shareholder register. For US investors, it means direct ownership of the company, bypassing the cumbersome American depository receipts, ADRs, that banks typically provide. This move broadens the investor base and positions AstraZeneca for smoother future deals in the US. Meanwhile, UK shareholders breathe easy knowing the company remains in the FTSE 100 index, preserving their interests. As CEO Pascal Soriot aptly put it, it's a global listing for global investors in a global company. But here's the part most people miss: HM Treasury is the big loser in this deal. With AstraZeneca shares now traded as depository interests, stamp duty, a 0.5% tax on share purchases in UK companies, no longer applies. That's a £200 million annual hit to the Treasury's coffers. And this is where it gets even more alarming: if other FTSE 100 giants follow suit, the government's £3 billion in annual stamp duty receipts could crumble. So, what should Rachel Reeves do? Step 1. Acknowledge the inevitable. The stamp duty reserve tax, as it stands, is outdated and uncompetitive. At 0.5%, it's one of the highest rates globally. The US, China, and Germany charge nothing, and even Ireland's 1% rate is higher. Worse, it disproportionately burdens UK retail investors and pension funds, while others easily sidestep it. As a tool to promote share ownership or boost London's market competitiveness, it's become a self-inflicted wound. Step 2. Turn necessity into opportunity. Reeves could use this moment to slash the tax, or better yet, abolish it entirely. If outright abolition feels politically risky, having the rate could stimulate trading activity. Half measures like a stamp duty holiday for new listings won't cut it. They're too minor and too complicated to make a real difference. The timing may seem inconvenient, but AstraZeneca's move has laid bare the flaws in the system for all to see. Ignoring this reality could see tax receipts dwindle anyway. Here's the controversial question: is the UK willing to sacrifice its competitiveness on the global stage to cling to an outdated tax? Or will it seize this moment to reform and reinvent? Let's hear your thoughts. Do you think stamp duty on shares is worth saving, or is it time to let it go? The debate is open, and the stakes couldn't be higher.